Hello students. So today we will be discussing about a new chapter, that is financial markets. So in our day-to-day life you might have come across different types of newspaper with headlines discussing about the Sensex. So the Sensex, or you might have also heard about Nifty. Okay, so you might have heard about stock market and the things that happen in the stock market, the Sensex, the Nifty, the share pricing going up and down. So it goes up and down all the time, and it seems to be a very important part of business and economics news. So Sensex is the benchmark index of BSE. So since the BSE is nothing but the Bombay Stock Exchange. So since the BSE has been the leading exchange of the Indian secondary market, so the Sensex has been an important indicator of Indian stock market. So it is most frequently used indicator while reporting on the state of the market. So an index has just one job: to capture the price movement. So the stock index will reflect the price movements of the shares, while the bond index captures the manner in which bond prices go up and down. Okay, so when Sensex, or if Sensex rises, it totally indicates the market is going on well. And since the stocks are supposed to reflect what companies expect to earn in the future, a rising index indicates that investors expect better earnings from companies. So it is also a measure of the state of the Indian economy. So Indian companies are expected to do well. Obviously the economy should do well. So the Sensex, it was launched in the year 1986 and is made up of 30 of the most actively traded stocks in the market. So in fact they account for half of the BSE's market capitalization. So they represent 13 sectors of the economy and are leaders of their respective industries. So we all know that a business, it needs funds from the time an entrepreneur makes a decision to start the business organization. So entrepreneur, what it does is he brings various plans, or he converts the problems or obstacles that are available in the economy into opportunities. He identifies the opportunities from the various kinds of problems that are available in the economy, and then he tries to turn those problems into opportunities and plans to start up a business organization. So from the very first way, or very first time an entrepreneur makes the decision to start it, so it needs finance both for working capital requirement. So when it comes to working capital requirement, like I told you in your previous class, so it may be payment of raw materials, or the salaries to the employees, and payment of other expenses like your electricity bill maybe, or your telephone bill maybe, or rents or rates or taxes or whatever it is. Okay, so the fund that are required for the day-to-day working of the business organization. So not just your working capital is enough, but also fixed capital expenditure is also very important for the business organization, such as purchase of machinery or building or to expand its production activity. Okay, so business, what it can do is, like, it can raise these funds from various sources in different ways through financial market. So in this chapter we will be studying about the different ways through which it raises funds, both in terms of working capital requirement as well as in terms of fixed capital requirement. So what is the total amount of fund it is raising through different sources in order to run the business organization, or in order to establish the business organization. So the first concept is concept of financial market. Concept of financial market. So business is a part of an economic system that consists of two main sectors. Like I told you, a business is a part of an economic system that consists of two main sectors. One is household, which saves funds, and business firms which invest these funds. Okay, one is household sector and the other one is business sector. So household sector, what it does is it saves the funds, and business firms are the one which invest these funds. So the financial market, it helps to link the savers as well as the investors by mobilizing funds between these two people. Okay, so in doing so, it performs what is known as allocative function. So it allocates funds that are required for the different purpose of the business organization. It allocates or directs funds available for the investment into most productive investment opportunities. So only when the funds are allocated into most productive investment opportunity, only then you can get a good amount of return out of those investment which is made. So when the allocative function is performed well, there are two consequences that will have to be followed. So one is the rate of return offered to households will be higher. The rate of return offered to households would be higher. And the second one is scarce resources are allocated to those firms which have the highest productivity for the economy. Scarce resources are allocated to those firms which have the highest productivity for the economy. So these two major alternative mechanisms through which allocation of funds can be made. Okay, so one is banks or via financial markets. So households can deposit these surplus funds with banks who in turn could lend these funds to the business firm. So households, what they do is like they will just total the amount, or they will just pool the amount, and what they do is like they will just deposit these funds, that is surplus funds with the banks. Okay, so they deposit these funds into the banks, and what this bank does is in turn it lends these funds to the business firm. So totally it's like circle. Okay, so what these household people or household sector does is it collects the fund, it saves the funds, and what it does is it invests or it deposits these funds into the banks. So bank in return, what it does is it collects these amount from household sector, and then it sees that these funds are lent for the business firms for its proper allocation. So alternatively, households can buy the shares and debentures offered by the business using financial markets as well. So the process by which allocation of fund is done is called financial intermediation. The process by which allocation of fund is done is called financial intermediation. So bank and financial markets are competing intermediaries in the financial system. Yeah, bank as well as the financial markets are competing intermediaries in the financial system, and give household a choice of where they want to place their savings. So they have different options when it comes to placing their savings. Elli invest ಮಾಡಬೇಕು ಅನ್ನೋದರಲ್ಲಿ ಅಥವಾ ಎಲ್ಲಿ ಡೆಪಾಸಿಟ್ ಮಾಡಬೇಕು ಅನ್ನೋದರಲ್ಲಿ ಅವರಿಗೆ there are different options, so they can select the best option which suits them. Okay, so what is this financial market? A financial market is a market for creation and exchange of financial assets. Financial market is a market for creation and exchange of financial assets. So financial markets they exist wherever the financial transaction occurs. So ಎಲ್ಲೆಲ್ಲ financial transactions occur ಆಗುತ್ತೆ ಅಥವಾ ಎಲ್ಲೆಲ್ಲ financial transactions ಆಗುತ್ತೆ ಅಲ್ಲೆಲ್ಲ financial management markets exist ಆಗುತ್ತೆ. So financial transactions could be in the form of creation of financial assets, maybe such as initial issue of shares or debentures by a firm, or a purchase and sale of existing financial assets like equity shares, then debentures, then bonds, etc. Okay, so wherever the financial transaction takes place, financial markets exist. Like I told you, financial transaction, it could be in the form of creation of financial asset, such as like I told you, such as initial issue of shares or debentures by a firm, or the purchase and sale of existing financial assets like equity shares, debentures, and bonds. So the next concept is functions of financial markets. Functions of financial markets. So what are the functions of financial market? The first one is mobilization of savings and channelizing them into most productive uses. Mobilization of savings and channelizing them into most productive uses. So the financial market, what it does is it facilitates the transfer of savings from savers to investors. It facilitates transfer of savings from savers to investors. That is from household sector to business firm. Yeah, like I told you previously, it collects the fund from the households, or households, what they do is like they save the fund and those funds will be deposited into the bank. So bank, what it does is it lends these amount which are deposited by the households to the business organization. So that is nothing but transfer of savings from savers to investors. So it totally gives the choice of different investment and thus helps to channelize surplus funds into most productive use. So you have surplus funds. When you have excess of deposits in the business organization or in the banks, it's like you have surplus amount that are available. So what you can do is like this surplus amount can be totally invested in the best productive manner, or you can totally channelize the surplus fund into most productive uses so that you get a good result out of those investments that are made. The second one is facilitating price discovery. So you all know that the forces of demand and supply help to establish the price for the commodity or service in the market. The price or the forces of demand as well as supply. Not just demand plays a main role in the market. Just like demand, the supply also plays a very important. Why? Because demand without supply is also of no use, and supply without demand is also of no use. So you don't get any benefit out of demand without supply as well as supply without demand. So all you do is like you bring the proper establishment between the demand and supply. So this helps to establish a price for the commodity or service in the market. So here in financial market, so the households are suppliers of fund and business firms represents the demand. Okay, so households are suppliers of funds, so they are the one who are supplying the funds that are required, and the business firms are the one who represents the demand. So demand is created by the business firms, or the funds are demanded by the business firm. So households, what they do, they provide the funds that are required, and the business organization use those funds that are provided by the household. So the interaction between them helps to establish the price for the financial assets which is being traded in that particular market. The interaction between these, that is the households as well as the business firm, it helps to establish a price for financial asset, or it helps to establish the price for financial assets which is being traded in that particular market. The third one is providing liquidity to financial assets. So financial markets, they facilitates easy purchase as well as the sales of financial assets. So easy purchase as well as sales takes place in the financial market. So in doing so, what happens is like they provide liquidity of financial asset. When there is a continuous purchase and sale of financial asset, it leads to liquidity of financial assets, so that they can be easily converted into cash whenever required. Whenever the fund requirement arises, what you can do is like you can easily convert these financial assets into cash whenever required. So holders of assets can readily sell their financial assets to the mechanism of financial market. So like I told you, when the requirement of fund arises or cash requirement arises, what they do is like they sell these assets or financial assets, and then they can convert these financial assets into cash that is required. The fourth one is reducing the cost of transaction. Reducing the cost of transaction. So financial market, it provides valuable information about securities that are being traded in the market, so that the person who is an investor gets a proper idea regarding the securities that are available in the market. So it helps to save time, effort, as well as money that both buyers and sellers of financial asset would have to otherwise spend, try and find each other. So it's like I told you, when they provide a proper information about the securities that are traded in the market, both the buyer as well as the seller, they can totally save their time as well as their money and effort in searching of different kinds of financial assets that are available in the market. So both the buyer as well as the seller can save time, effort, as well as the money. So the financial market is a common platform where buyers and sellers can meet for fulfillment of their individual needs. It is a market, common platform, or it is a market or a common platform where both the buyers as well as the seller can meet each other for fulfillment of their individual needs. So the financial markets, they are classified on the basis of maturity of financial instruments traded in them. So instruments with a maturity of less than 1 year is traded in the money market, and instruments with longer maturity are traded in the capital market. Like I told you, it is classified, that is, financial markets are classified on the basis of maturity of the financial instruments traded by them. So on the basis of these maturity, it is divided into two. So the instruments with maturity of less than a year, yes, the instruments that are having a maturity of less than a year are traded in the money market, whereas the instruments with longer maturity are traded in the capital market. So the next concept is a money market. Money market. So money market, it is a market for short-term funds which deal in monetary assets whose period of maturity is up to 1 year or less than 1 year. Money market is a market for short-term funds which deals in monetary assets whose period of maturity is up to 1 year. So these assets are close substitutes for money. These assets are close substitute for money. Why? Because like I told you, it can be converted into cash at any time, and the maturity period of these kind of assets are relatively less. It is less than 1 year. So it is a market where low risk, unsecured and short term debt instruments that are highly liquid are issued and actively traded every day. So it's like only the short term debts with unsecured as well as low risk are traded in these kind of markets. So there has no physical location, but is an active conducted over the telephone or through internet. Just like this is nothing but the transaction which takes place through internet. So there is no physical location in these kind of markets. It enables the raising of short-term funds for meeting the temporary shortage of cash and obligations, and the temporary deployments of excess funds for earning a return. So like it is said, it totally enables the raising of short-term funds for meeting the temporary shortage of cash. So there are chances that the business organization may come across temporary shortage of funds. Okay, so when it comes across these temporary shortage of funds, then what they do is, like, in order to meet the temporary shortage of cash and obligations, so this funds are most of the time used. So the major participant in market are RBI, commercial banks. The major participants in markets are RBI, commercial bank, non-banking financial companies, as well as state government and large corporate houses, as well as mutual funds. So the main participant of these kind of markets, that is money market, are, one is RBI, that is Reserve Bank of India, then the commercial bank maybe, or the non-banking financial companies, and sometimes your mutual funds, the state governments, as well as the large corporate houses. The next concept is money market instruments. Money market instruments. So under money market instrument, the first one is treasury bill. Treasury bill. So a treasury bill is basically a instrument of short-term borrowings by government of India, maturing in less than 1 year. So the maturity of this kind of items, that is your treasury bill, is less than 1 year. Like I told you, a treasury bill is an instrument of short-term borrowings by the government of India, so maturing in less than 1 year. Maturing in less than 1 year. So generally the duration of this varies from 14 days to 364 days. So this is not available in your textbook, but still for your basic knowledge. So the maturity or the duration varies from 14 days to 364 days. So this treasury bill, they are also known as zero coupon bonds. They are also called as zero coupon bonds and are issued by government of India on behalf of central government to meet its short-term requirement of funds. So they are called as, or they are also known as zero coupon bonds. They are also known as zero coupon bonds, which are issued by RBI, that is Reserve Bank of India, on behalf of central government to meet its short-term requirement of funds. So this traditional treasury bill are issued in the form of promissory notes. These bills are in the nature of promissory notes. They are totally liquid. That is, they are highly liquid, which has assured return and negligible risk. They are highly liquid and have assured yield or return and negligible risk of a default. So they are issued at a price which is lower than their face value, and repaid at par. And it is repaid at par. So they are issued at a price which is lower than the face value. So the face value is 100. If the face value is 100, then they are issued at 90. For example, this is just an example. So if the face value of the treasury bill is 100, then they are sold at a price which is lower than their face value. So lower than the face value is nothing but the price which is less than the face value. Like I told you, the face value of treasury bill, if it is 100, for example, then these kind of bills will be sold at 90 rupees, that is, which is lesser than the face value, and repaid at par. So when it is repaid, what they do is, like, they pay the amount of face value, that is rupees 100. So the amount of rupees 10 is the excess interest that is what collected while issuing the treasury bill. So the difference between the price at which the treasury bills are issued and their redemption value is interest receivable on them, and is called as discount. Okay, like I told you. So the amount or the difference between the 100 and 90. So this is nothing but the interest receivable on those treasury bills. The second money market instrument is commercial paper. So the commercial paper, they were introduced in 1990 as a money market instrument. Okay, so commercial paper, it is a short-term unsecured promissory note. It is a short-term unsecured promissory note which is negotiable and transferable by endorsement. It is negotiable as well as transferable from one person to another person by endorsement, and delivery with a fixed maturity period. So it is negotiable and transferable by endorsement and delivery with fixed maturity period, which is issued by a large and credit-worthy company. So they are usually issued by large and credit-worthy companies to raise short-term funds at lower rate of interest than market rates. So this commercial paper, so they usually have a maturity period of 15 days to 1 year. They usually have a maturity period of 15 days to 1 year. So it is sold at a discount and redeemed at par. Just like your treasury bill, this commercial paper is also sold at a discount and redeemed at par. The issuance of commercial paper is an alternative to bank borrowings for large companies that are generally considered to be financially strong. Okay, so the original purpose of commercial paper was to provide short-term funds for seasonal as well as working capital needs. The original requirement or the original purpose of commercial paper was to provide short-term funds for seasonal and working capital needs. Okay, so like I told you, it is sold at a discount and redeemed at par. So they yield higher returns as compared to treasury bills, and they are less secure in comparison with these bills. However, chances of default are almost totally negligible when it comes to these kind of bills. When it comes to your commercial paper, like I told you, the chances of chances of defaults are totally negligible. So they are totally less secure in comparison with the other bills that are available. So the third concept is call money. Call money. So call money is a method by which banks faced with temporary shortage of cash borrow the shortage or short-term finance from other banks. So sometimes there are chances that this bank may face temporary shortage of cash or fund. Okay, so at that particular situation, what they do is like they borrow the short-term finance from other banks. Okay, so this call money, it is a short-term finance payable on demand with a maturity period of 1 day to 15 days used for inter-bank transaction. So the commercial banks, it becomes very important for them to maintain a minimum cash balance, which is known as cash reserve ratio. Okay, the minimum balance which is maintained by the bank is called as cash reserve ratio. So the RBI changes the cash reserve ratio from time to time, which in turn affects the amount of funds available to be given as loan by the commercial bank. So there are chances that these RBI changes the CRR from time to time. So this totally affects the amount of fund available to be given as loans by the commercial bank. So why? Because when cash reserve ratio changes, obviously the fund availability in the commercial banks, that also will have a change. So it totally affects the business organization. So the commercial bank, what it does is it totally raises the short-term finance by this call money method. Okay, so this is the one way of through which the bank raises funds that is required by it. So call money is a method by which banks borrow from each other to be able to maintain the cash reserve ratio. So here it's like the interest rate paid on call money loans is known as call rate. The interest amount which is paid on this call money is known as call rate. So it is a highly volatile rate that varies from day to day and sometimes even from hour to hour. The interest rate paid on call money, like I told you, is known as call rate, and this rate is highly volatile. Volatile is nothing but which keeps changing, so which varies from day to day and even from hour to hour. So it is totally fluctuating in nature, so it may change at any time. It may go high or it may come down. So there is an inverse relationship between call rates and other short-term money market instruments such as certificate of deposit maybe or commercial paper. Okay, so a rise in call money rates makes other sources of finance such as commercial paper as well as certificate of deposit cheaper in comparison for bank raised funds from these. In comparison for the banks which raise funds from these sources. So most of the time what happens is like this becomes, that is call money rates makes other sources of finance such as your commercial paper and certificate of deposit cheaper in comparison for the banks raise funds from these sources. Okay, so usually what the bank does is it raises funds through these kind of sources in order to maintain the CRR, that is cash reserve ratio. So the next fourth money market instrument is certificate of deposit. Certificate of deposit. So certificate of deposits are totally unsecured negotiable instrument in bearer form issued by the commercial bank. So they are unsecured negotiable instruments in bearer form, and they are totally issued by the commercial bank. So they can be issued to individuals, corporations as well as the companies. They can be issued to individuals, corporations as well as companies. So in your textbook they have given that issued by commercial banks and development financial institutions. So they can be issued to individuals, corporations and companies during the period of tight liquidity, when the deposit growth of bank is low, where the demand for credit is high. So when the deposit growth of bank is low, when there is a tight liquidity, when there is no liquidity of funds, at that particular situation the certificate of deposit is used. So they are issued by commercial bank and development financial institutions. So usually most of the time it is issued by commercial bank. Okay, so the certificate, it bears maturity date as well as the fixed rate of interest and the maturity value. So generally it's like the maturity of the deposit is between 3 months to 1 year. The deposit or the maturity period of these kind of money market instruments, that is your certificate of deposit, is 3 months to 1 year. So they are stamped and they are totally transferred by endorsement. So the return on the certificate of deposits, they are totally higher than your treasury bill, because it assumes high level of risk. So it considers, or it has a huge amount of risk. So for that reason this certificate of deposit are higher than treasury bill. Okay, so the reason why it is higher than treasury bill is because it assumes higher level of risk. So the last money market instrument is commercial bill. So commercial bill is a bill of exchange used to finance the working capital requirement of business organization. So the commercial bill can be said that they are short-term negotiable as well as self-liquidating money market instrument with a totally less amount of risk. So like I told you, it is a bill of exchange used to finance the working capital requirement of the business organization. Okay, so it is self-liquidating instrument which is used to finance the credit sales of the firm. It is a self-liquidating instrument. It is a self-liquidating instrument used to finance the credit sales of the firm. So when the goods are sold on credit, so what happens is like the buyer becomes liable to make payment on a specific date in the future. So you have already studied about the bills of exchange in your previous classes in accountancy. Okay, so when the buyer he becomes liable for making payment on those kind of purchases he has made on the specific date in he will have to make payment on a specific date in the future. So seller could wait till the specific date or make use of the bill of exchange. So the seller is also called as a drawer of the goods. What he does is like he will draw a bill and the buyer accepts it. That is, the drawee accepts it. So on being accepted, the bill becomes marketable instrument and it is called as a trade bill. Okay, so these bills can be discounted with the bank if the seller needs funds before the bill matures. So suppose if the person, that is a seller, if he is in requirement of fund before the maturity period, then what he can do is like he can take these bills to the bank and then he can get the bills discounted. So when the trade bill is accepted by the commercial bank, it is known as commercial bill. When a trade bill is accepted by commercial bank, then it is known as commercial bill. Okay, so these are all about the different kinds of money market instrument. So So the next concept is capital market. Capital market. So the capital market, that is a market for long-term funds. So when money market deals with short-term funds, the capital market it totally deals with long-term funds, just as money market is a market for short-term funds. Okay, so this capital market it totally refers to institutions and mechanism whereby long and intermediate term funds are pooled and made available to individuals as well as business and government. So in short, the market dealing in the long and medium term fund is known as capital market. Market dealing in long as well as medium term funds is known as capital market. So it is a market for financial assets which have a period ranging between 1 to 25 years or more. Capital market, like I told you, it is a market for financial assets which have a period ranging between 1 to 25 years or more is termed as capital market. So these funds are utilized in making investment in fixed assets. These funds are utilized in making investment in fixed asset. So it consists of series of channels through which savings of the community is are made available for industrial as well as the commercial enterprise and for public and general. So it directs these savings into their most productive use, leading to growth and development of the economy. So the capital market, it consists of development banks, commercial banks and stock exchange. So a capital market is the one where finance is available at reasonable cost. So the process of economic development is facilitated by the existence of well-functioning capital market. In fact, a development of financial system is seen in the necessary condition of economic growth. So it is essential that financial instruments are significantly developed and that market operations are free, fair, competitive and transparent. Okay, so yeah, it's like the funds are utilized, like I told you, the funds they are utilized the funds are utilized in making investment in the fixed assets or utilized for making investment in the fixed assets. So the instruments that are dealt in capital market are like stocks maybe, or your the stocks maybe, or your shares or debentures, the bonds or securities of the government, etc. So capital market, it consists of various players like companies or individual investors or institutional investors and various other intermediaries like brokers or the merchant bankers, lead managers, etc. Okay, so capital market is one of the significant aspect of every financial market. It plays an important role. It plays an important role in the national economy. So a well-developed and dynamic capital market is indispensable for the speedy economic growth and development. The next concept is distinction between capital market and money market. Distinction between capital market and money market. So this is a very important concept and this can be asked for 4 marks in your final examination. Okay, so distinction or difference between capital market and money market. The first one is participants. So the participants in capital market are financial institutions, banks, corporate entities, foreign investors and ordinary retail investors from the members of the public. Okay, so the investors are totally the members of the public. Like I told you, it may be financial institutions or banks or corporate entities or foreign investors and ordinary retail investors. So participation in the money market is by the large undertaken is by and large undertaken by institutional participants such as RBI maybe, or banks or financial institutions and finance companies. So money market in the sense, like I told you, for the year of for the period of less than 1 year, and your capital market is for the year of for a period of more than 1 year. Okay, so the participants here under money market are, one is Reserve Bank of India, the other banks, the financial institutions as well as finance companies. company. So individual investors, although permitted to transact in the secondary money market, do not normally do so. Okay, so individual investors are permitted to transact in the secondary money market. Okay, so there are also difference between your under capital market you have two types, like primary capital market and secondary market. Okay, that is primary market and secondary market. So we'll not discuss about what is primary market and secondary market now, because there are chances that it may confuse you. Okay, so we will just speak about what is capital market and money market. So participant, like I told you, when it comes to capital market, are financial institutions, banks, corporate entities, foreign investors, etc. When it comes to your money market, they are RBI, bank and other banks, financial institutions and financial companies. The second one is instruments. So the main instruments traded in capital market are equity shares, debentures, bonds and preference shares. The instruments involved in transaction when it comes to your capital market are equity shares, that is stocks, shares, debentures, bonds and government securities. Okay, so the main instruments that are traded in money market are short-term debt instruments like your trade bill, treasury bill, call money, certificate of deposit, commercial bills, all those things. Okay, so it may be all those money market instruments. So instruments that are traded under money market are short-term debt instruments like treasury bills or call money or certificate of deposit or commercial papers or commercial bills. The third one is investment outlay. So when it comes to investment outlay, so the investment in capital market, that is securities, does not necessarily require huge financial outlay. It does not require huge financial outlay. So the value of units of securities are generally low. The value of units of securities are generally low. Okay, so in case with minimum trading, lot of shares which is kept small or so. So this helps individual with small savings to subscribe to these securities. Okay, so the outlay, the capital outlay or investment outlay of capital market are relatively low, so it becomes easy. It helps the individual with small savings to subscribe to these securities. But when it comes to your money market, the transactions entail huge sum of money as the instruments are quite expensive. The instruments are quite expensive when it comes to money market. The fourth one is duration. The capital market deals in medium and long-term securities such as equity shares and debentures. So I've already explained this. The duration of the capital market is high because of the reason that they deal in medium and long-term securities. But when it comes to money market instruments have a maximum tenure of 1 year and may even be issued for a single day. So the maturity period of money market is relatively very less. That is from 1 year to 1 day to 365 days. The next one is liquidity. So when it comes to liquidity, the capital market securities are considered liquid investments because they are marketable on the stock exchanges. They are considered as liquid investment because of a reason that they are marketable on the stock exchange. So however, it's like a share may not be actively traded. That is, it may not easily find a buyer. But when it comes to your money market instruments, so they enjoy a high degree of liquidity. They enjoy high degree of liquidity when it is compared with capital market securities or capital market instruments. Yeah, so they enjoy a high degree of liquidity as there is normal arrangement for this. There is a normal arrangement for this, so they can enjoy a high degree of liquidity. Next one is safety. So capital market instruments are riskier both with respect of returns and principal repayment. Capital market instruments are riskier both with respect of returns and principal repayment. There are chances that the issuing companies may fail to perform as per the projections, and promoters may defraud investors. Why? Because the amount that are invested on these kind of ventures are relatively big, and the tenure of these kind of instruments or these kind of capital are also high. Okay, so it's like the money market. When it comes to money market, the money market is generally much safer with the minimum risk of default. It is much safer with minimum risk of default. So this is due to the shorter duration of investing and also the financial soundness of the issuers. It is because of the shorter duration of investing and also the financial soundness of the issuers, so which primarily are the government, banks, and I-rated companies. So it's like they are less risky. Money market instruments are less risky, whereas capital market instruments are more risky. The last one is expected return. The investment in the capital market generally yield higher return for investors than the money market. So main reason for this is that money market is invested for a small period of time, whereas capital market is issued, or it is invested. Investment takes place for a long period of time or a long duration of time. So it's like the capital market generally yield higher return for investment than the money market. So the possibility of earnings is higher if the securities are held for longer duration. The possibilities of earnings is higher if the securities are held for longer duration. So first, there is the scope of earnings of capital gains in equity shares. Second, in long run, the prosperity of company is shared by the shareholders by way of high dividends and bonus issues. So all these are advantages for the capital market runners or capital market investors. Okay, so these are all about the distinction between capital market, or the difference between capital market and money market.